Welcome to The Explainer. Today, we're diving deep into some high-stakes drama that's unfolding inside America's central bank, the Federal Reserve. And this is a story about ethics, politics, and, believe it or not, how all of it could have a direct impact on your wallet. So let's just ask the big question right up front. Is the independence of the Federal Reserve actually under threat? Because, a whole series of recent events suggest that the one institution that was designed to be completely above politics is getting pulled right into the thick of it. And the crazy thing is, this whole story doesn't even kick off with a big debate over interest rates. No, it starts with something that really caught people by surprise, a string of ethics scandals that involved some of the Fed's most powerful officials. So let's talk about who we're dealing with here. First up, you've got Fed Governor Adriana Kugler, who recently resigned. And then there's Raphael Bostic, the president of the Atlanta Fed. He also faced a ton of scrutiny and has announced he's retiring. And look, these are not minor players. These are major figures who are shaping U.S. economic policy every single day. And when you lay it all out on a timeline, you start to see this really troubling pattern emerge. See, back in 2022, after another scandal, the Fed made its ethics rules way, way tighter. But then, fast forward to this year, and we see Governor Kugler's spouse making trades during these off-limits periods. That led directly to her resignation in August. And now, President Bostic, who was also flagged for violations, is heading for the exit. It's clear those new, stricter rules are really being put to the test. Okay, so we've seen the fallout. Let's really dig in here. What were the actual rules? And, how exactly were they broken? The most important idea to get your head around here is the blackout period. Think of it as a quiet zone. It's this window of time right around those huge Fed meetings where they decide what to do with interest rates. During that time, top officials are totally banned from trading. And the whole point here, it's not just about stopping actual insider trading. It's about stopping even the hint of a conflict of interest, just to maintain public trust. So this 2022 ethics overhaul, it was a big deal. They tried to lock things down, no more owning individual stocks, no trading at all during those blackout periods. You also had to disclose every single trade on time and get pre-clearance from the ethics folks. These rules were put in place for a very specific reason, to prevent exactly this kind of mess. But look, these resignations, they are so much bigger than just an ethics issue. What they do is create this massive power vacuum at one of the most powerful economic tables on the planet. And as you might guess, that vacuum is getting filled very, very quickly. And boom, here's the immediate result. Adriana Kugler, she's out. And stepping into her spot, Steven Meisran, who was a senior advisor at the Treasury Department under the Trump administration. So right there, that one swap starts to shift the whole dynamic of the board. And this, right here, is where we get to the absolute heart of the matter. Because these changes, they aren't happening in a bubble. They seem to be part of a much bigger and much more direct push for political influence over the Fed's main job, setting interest rates. And the new guy, Steven Mehren, he did not waste a single second. In his first two votes, he was the only one to dissent, arguing for bigger interest rate cuts that just so happened to line up with the administration's economic goals. This is a big deal because it signals a potential break from the way the board has traditionally worked, which is by building consensus. But it looks like this isn't just about one seat. The strategy seems to be way, way bigger. There's also this public pressure campaign to get rid of another sitting governor, Lisa Cook, and then there's this big date looming in February, the reappointment of all 12 regional Fed presidents. The administration could try to use its influence on the board to block them. When you add it all up, the endgame seems pretty clear. Get a majority of White House appointees onto the Fed's governing board. So all this inside Washington drama, why should you care? Well, because, and this is the crucial part, the Fed's independence isn't some high-minded abstract idea. It has very real consequences for your mortgage, your car loan, and just the general health of the entire economy. And look, we're not the only ones saying this is a big deal. Some of the sharpest minds in economics are sounding the alarm big time. Mohammed El-Arian says this is threatening to politicize the whole system in a way we've just never seen before. The words that really jump out there are unprecedented and unpredictable. And to really grasp how huge this is, listen to this from the Wall Street Journal's Greg Ip. He warns this could literally be the end of an era. The Fed has basically been independent from direct White House control since 1951. We're talking about undoing more than 70 years of economic policy. Okay, so let's trace exactly how this inside baseball in D.C. ends up hitting your wallet. It all starts with a perception of political influence. That makes global investors, the people who buy U.S. debt, nervous. If they start questioning how stable our economy is, they're going to demand higher interest payments to lend us money. And that extra cost, it gets passed right on to you. The bottom line, interest rates for mortgages, car loans, and credit cards go up. And here's the wild paradox in all of this. It's kind of mind-bending when you think about it. All this political pressure is designed to force the Fed to lower interest rates. But the very act of applying that pressure could spook the markets and end up making the long-term rates that affect your loans actually go up. And listen, this isn't just some economic theory we're talking about. We have a perfect real-world example of this happening just last year. The Fed cut its main policy rate by a full percentage point, which sounds great, right? But at the exact same time, mortgage rates actually rose by a point. Why? Because the market got worried that the Fed was losing its grip on inflation and investors demanded higher returns to cover that new risk. And all of this brings us back to the one massive question hanging over the entire U.S. economy. The Federal Reserve was created to be this stable, independent anchor, protected from the day-to-day political winds. But now, facing these scandals and this intense political pressure, can it actually stay that way?